All right, so let's take a look at several of the Chapter 6 textbook problems, and there are several of these, so I'll probably create this in two separate videos. And so this will be probably video part 1, and then we'll have a video part 2, because again, there are several little different transactions I want to take a look at. All right, so we'll get started. So first we'll look at is 6-2, and on this particular one, we're going to be using the equation, the inventory equation, to back into cost of goods sold and purchases for the third quarter. So they give us the background information. You can read all that. And then on the next slide, we'll kind of show you the summary again of what they've given us. All right, so you'll notice that they've given us inventory at the end of the quarter and inventory at the beginning of the quarter. So we got beginning and ending inventories. They've given us net sales, gross profit, and of course, net income. So we know by our multi-step income statement, if you were to take your net sales and subtract out your cost of goods sold, you get gross profit. So in this problem, we know net sales and we know gross profit. So the difference between those two has to be cost of goods sold. So that's how they're backing into cost of goods sold. All right, now, so now that we know cost of goods sold, we can use that information now to back into what they purchased. All right, so let's take a look at the next slide. And as you can see, here's our formula for what our relationships are with cost of goods sold and inventory. Since we know the beginning inventory and the ending inventory, and then of course, now that we know cost of goods sold, we can plug it into this equation and then back into purchases. Now, if I were in a face setting in class, what I would do is I would write it out like this. I would say, okay, we've got beginning inventory plus purchases equals your available for sale inventory. And then of course, when you subtract out your ending inventory, that's going to give you cost of goods sold. And I would highlight that the only thing we don't know here now is the purchases. That's our only unknown. So once you plug in these numbers, if you've got 1.3 in billions for cost of goods sold, and we know inventory is 1.7, and we know that beginning inventory is 1.1, all you have to do is just use your math, and therefore you could then back into purchases, which is essentially what they did right there. So that's typically how I would show it in a face-to-face setting if this formula confuses you. All right, next one, 6-4. So what we're going to do in this one required, it says if the cost of inventory purchases was 24.6, what was the cost of shrinkage during year 2? Assume perpetual inventory. So again, they give us that they report a cost of goods sold before shrinkage of 21 billion. Ending inventory for the year was 9.2, and ending inventory for the previous year was 7.7. So in the next slide, let's show you the breakdown. So again, here's information we know. We got cost of goods sold. We've got the beginning and ending inventories. We've got purchases. So if we plug it into our formula, beginning inventory plus our purchases, and of course, subtract out your cost of goods sold, you get your inventory prior to shrinkage. That's what you think on the books it would have showed, but the actual account was 9.2. So the difference would have been the shrinkage of 2.1. The point is we're still looking at that formula, that cost of goods sold formula that you would have used for a periodic inventory system. All right, next one, 6-8. So on this one, we are going to be looking at, I believe it's perpetual inventory. It says assume they use perpetual inventory and they had no inventory at the beginning of the month. They want you to calculate the cost of inventory as of January 31. So you've got all these purchases, and note that you also have discount situations that could actually reduce your cost. So we got on the 5th and the 10th, we've got two discount situations. And then they're going to tell us when we paid the spade. So it looks like for the spade purchase, we're going to get the discount. And for the Pride, that was on the 10th, and they got to pay within 10 days, and they did not because they paid it after. So on that one, you will not get the discount. So on the next one, let's show you the summary in terms of how you get that cost. So again, they're emphasizing, again, like I just said, the terms. And then, of course, they're giving you the cost items. So all these purchases add up to 5,400. And of course, there was, in this case, it looks like there was a return of 1,500. So note that would have reduced your total purchases right there. And then of course, there's your purchase returns. And then of course, there's that one discount. And that discount was, they're showing you this because we had that return. The discount was 2% of that 3,900. So that's a discount. And of course, the other return. And then you add up your other purchases and you'll note this 1,800, we don't get a discount on that one. So if you just net these, your total cost should be right at 5622. All right, next one. So on this one, it says, for example, we've got determine the months, during the months of January and February, Ruby Corp sold goods to 2 customers. The sequence of events were as follows. So it looks like on this particular slide, let me check the next one, it looks like they ran together. On the overlap, it's kind of hard to see what they're doing, but it looks like they give us on January 3rd, they sold goods to Diamond. Notice there's 2 discounts. There's a discount situation. The goods cost Ruby 90. We sold goods on the 8th to Hubs. Again, terms 3, 10, and 30. The goods cost Ruby 45. And then it says, I guess it's kind of hard to see this one, but it says on the 11th, they collected the cash that was due from Diamond. So that one would be within 10 days. So they're going to get the discount. And then it says on February 2nd, they collected cash from Hubs. And on that one, they are not going to get the discount because that's after 10 days. And then I believe the last one says that was on the collected cash from Hubs. And then what they want you to do in total is to compute the total revenue they would report over 2 months. So on the next slide, let's see if we can show you how this would work. So you'll know that there's $150 right there of revenue, and there's 60. So there's where they get the gross revenue. And then in terms of discounts, this customer is going to get a discount. So there's 2% of that we have to take down. But that's essentially it, because the Hubs do not get the discount because they're not going to pay us until February 28th. So it looks like the net sales would be 207. All right, next slide. So next one, same scenario. They want you to compute the amount of revenue to be reported for the month of September. So you have some sales and you got some collections. And then of course, they're wanting you to work out if you have any discounts. So watch the discounts. If there are any, so on the 12th, there looks like there's a discount situation. On the 19th, there's a discount situation. And once you have those, look to see when we actually receive payment to see if the customer is going to actually get the discount. So in this one, they're coming up with this. So we've got the first sale. There's no discount on that one. So that's going to be part of your revenue. Then we've got 9,000. So there's gross. And then there's 2,500. So the first 3, these are just the gross revenues. And then on the discounts, the only discount in this case, this is to the Fox. They don't pay us until the 30th. So that's after the 10 days. So they don't get the discount. But it looks like Happy Furniture, which we sold on the 12th, they pay us by the 21st. So the Happy group will get the discount off that 9,000. So 3% off that would be 270. So if you net that, our net revenue would be 12,980. I think that's it on that one. All right. 16-12. Again, same scenario. Wanting you to compute total revenue to be reported. So we got November and December. And again, they give you the sales. Watch out for the terms. Look for the discounts if there are any. And then also kind of track it to see if there's any returns. And also when the balance was paid in full. So on the next slide, let's illustrate this. So again, this is on the 18th. And on this one again, you notice it says we sold 2 items of merchandise to Mary Clark, who paid the $800 sales price in cash, and the goods cost Parker $650. So of course we know that that $800 would be part of your gross revenue. And then it looks like on this one, they're showing us they sold 20 items of merchandise to Turner at a selling price of $5,000. Terms were 210 and 45. And notice this 5,000 will also be added to your revenue. Again, that's gross revenue, but there is going to be a discount situation if they pay us early. We've got another 7,500 we're adding to that. So notice 7,500 of additional items. Again, note there could be a possibility of a discount, but again, this is just the gross. And then here we're showing we've got, we sold another 15 identical items of merchandise at a selling price of 7,500. In fact, I think we got that one. That comes out to, if it's 15 items, that comes out to $500 per item. So I believe there was one return. So therefore we have to reduce our revenue by one of those returns by the item, by the revenue per return. So that would be how they come up with that $500. And then of course, here's a couple discount situations is once you returned it, then the discount would be calculated on the 7,000, not the 7,500, and there's 3% because they pay us early. So that'll be part of the discount there that will reduce our revenue, our gross revenue. And I believe that was the last one. So net revenue, if you go back and review the items, should be $12,590. All right, exercise 614. All right, so on this one, we're going to be doing the perpetual method. And they want us to do the entry for the sale for both. This is for the Thomas Corp. And they want us to do the return of goods. And then they want us to do the entry when they are collecting the money. And then they want us to calculate the gross profit percentage. So let's check out the entries on the perpetual method. Remember, there's two entries on the sale. You've got the actual sale, which is on account. Notice accounts receivable, sales revenue. And then here's the cost of the sale, which is $1,500. You debit cost of goods sold, credit inventory. And then on this one, when there were a good return, they're just showing you how you would calculate the individual return. And in this case, it looks like it was 1/4 or 1/4 was returned, so that's 25%. So the return would be basically you're canceling, reversing the original sale. So you'll debit the sales revenue, credit accounts receivable, debit inventory, credit cost of goods sold. So it's just basically reversing that original entry. All right. And then of course, when you've got the collection, so on this one, there was no discount situation. You just had to account for the return. So it's $2,400 minus whatever was left over. So it was $1,800. So debit cash and credit accounts receivable for $18. So remember, just going back, this is where you'd reduce that accounts receivable by that $600. All right, just in case you were wondering where that came from. All right, and then the last thing, they've kind of muddied this one together. I think there was some sort of issue with the with some of the animations, but if you go back and calculate it, just remember your gross profit percentage. Remember you have to calculate your gross profit, which again, let me just kind of write this out so you can go back and you can look at the actual other PowerPoint handout. You can see the actual numbers, but remember it's your sales minus your cost of goods sold equals your gross profit, and your gross profit percentage is just taking that gross profit and dividing that by, in this case, it'll be by your net sales. In this case, you're going to get about 0.389 or 38.9%. So again, I apologize. This kind of came over, this part right here just kind of looks like it got jumbled together so you can actually see the calculations, but that's the basic idea, again, of how you get that gross profit percentage. All right, so this is exercise 615. We'll do a couple more and then I'll pause this recording and then we'll do a recording number 2. That way the video doesn't get just too long. All right, So on this one, we've got determining the dollars of revenue that should be allocated to equipment for each bundled sale. Determine the dollars of revenue that should be allocated to the service for each bundled sale. And then we've got determine the dollars of sales revenue and service revenue from the July 1 bundled sale that should be reported on the income statement for this particular period. All right, so on step 1, it says determine the dollars of revenue that should be allocated to the equipment. So again, we've got the equipment price. And in this case, it looks like it was, let me kind of highlight this. It says they sold home security equipment at 12 months and 12 months of system monitoring for $180 and $360 respectively. And so in terms of, it says the company sells an equipment monitoring bundle on July 1st for a total price of $360. The monitoring service begins immediately after the equipment is delivered and installed on July 1st. So in this case, the proportion of cost, in this case, total price is $360. And it looks like you're simply just taking a simple ratio in terms of the cost. So if you go back and look at the numbers, you've got they sell the home security equipment and 12 months of monitoring for $180 and $360. So for the equipment proportion, the equipment's $180. So $180 divided by the total price would be the equipment proportion would be, looks like this would be 1/3. And then so that basically of the total price of the sale price of $360, you would just take $360 times 1/3, and that would be the amount that would be allocated for the equipment, which again would be $120. So again, it looks like the amount they're putting on here, and let me write this one in. It looks like it's 180 because these numbers kind of got jumbled together. 180 divided by the total, which would be 180 plus 360, and then that's where they're getting essentially 1/3. That's how they essentially came up with that number. All right, on slide 36, then we want to do the same thing. So the service proportion, it's going to be the same idea. Let me write this number out again for the service part of it. So for the service, so it would have been, it looks like it would be 360 divided by 180 plus 360. So again, that's going to give you 2/3. That's where they're going to get that number. And then again, multiply that by the sales price. That's how much should be allocated for the service. All right, and then one more. So now then we look at determining the dollars of sales revenue from the July 1st bundle that should be reported on the income statement. So for the sales revenue, we know it's going to be 120 that we just calculated. And then for that service revenue, because they got the equipment, it's over 12 months. So it's that 240 allocated price divided by 12. They got that 20 is how much is technically reported for July. Add that to the equipment because they got the equipment now. Total should be 140. All right, so I'm going to pause this particular recording, and then there's going to be a part 2 on the chapter 6 textbook illustrations. Just that way this video doesn't get too long.